I call it unsecured working capital.
Unsecured working capital. I
And
like
then
that.
there's a couple of nuances within that, which probably doesn't really matter much to the customer. But yeah, so unsecured working capital is this is an interesting product. It's only really about 10, 15 years old, but it's based upon a lot of data analytics. And so we can get away from needing an asset per se, as long as we can demonstrate that the business has cash flows sufficient to pay back the working capital loan. And I be a little bit more specific about that. What we analyze really is through bank statements. And there's some automated platforms, so you don't have to send us PDFs of your bank statements. We have some third parties that we can actually look at your bank statements with your okay. So you can kind of do this while on the road. But what we're looking at there is we're looking at cash flow. And so we're looking at how much do you have in the bank on average on a daily, a weekly, and a monthly basis. And we want to make sure that the cash flow of the business supports the ability to make those payments based upon how much we're lending. Because nobody wants to do a working capital loan that's going to drive somebody, out of business.
Right.
So we do a cash flow analysis. And what we're doing there is we're typically taking a weekly payment instead of a monthly payment. And the concept there is, instead of taking one giant bite once a month, we're taking a little nibble once a week. And so it's less of a burden on the business, especially in trucking, where they're getting paid, as they haul, they're getting paid. As they haul, they're getting paid. And this can actually be an alternative to freight factoring if somebody's looking at that.
That's what I was thinking. And I mean, because the factoring terms are really high, as I recall. I haven't looked at one in a couple of years, but I know it's really high. This is pretty small, what you take out a week, right? Just like a couple of points and that's it.
Yeah, it kind of comes down to like a half a point per month. So on a weekly basis, there's not a perfect 4 weeks in the year, but on a weekly basis, it's like, 0.125, something along that. So it is really meant to be, it's meant to be little nibbles throughout the course. And these terms go anywhere from 4 months to 18 months long. So it's really what we do is we present a number of options to the customer, and it's what they're comfortable with.
And I mean, and you talked about it with the asset base, but what they can use the capital for is the same sort of things, right? Same spending. It's all good.
It's actually whatever. So we actually wire or ACH the funds into your account within about 24 hours, and then how you use those funds. I mean, we want you to use them for business proceeds, obviously, right? No paying off gambling debts, but
right.
But no, I'll give an example, and then sometimes there's what we call pay proceeds, where the customer may dictate they want us to send money. And I'll give an example. We had a trucker down in Florida. He was broken down, and so we wound up wiring money to a towing company to get his truck into service, and then he got the balance of the funds. So once the repairs were done, he paid for them, and that was his use case in that particular scenario.
Wow, that's really cool. And then, but I'm glad you brought up that specific example, because I realized there was something I meant to ask you with the other stuff we talked about that we didn't, but this is a perfect opportunity for it. So what about the person's ability to pay earlier? What if, like you say, it really was for just this emergency situation, and you got the capital, resolved the situation, great, guy goes back out there, he's making, his good rates, and he's able to just pay it off quicker. Is that okay? Are there any penalties there? Yeah,
there's never a penalty for it. What we do is the way that those particular products are set up is they're set up as a term. So if you borrow whatever, let's just say 10,000, and the payback over a year is 11,500 or something along those lines, right? So if that early term payoff comes in, there'll be some discount from that remaining balance. Typically it's 6%. We take the present value, just discount that by 6%. So it winds up being a real savings. We do typically have a minimum time period, like the first 90 days. We want to make sure, because we have sunken costs, obviously.
Right.